Hello, good evening, everyone. So, today we will largely be talking about long term investing as an approach. So, generally, there are many investment approaches available in the market. So, today, what we will be talking is in a generic way, we will talk about what long term investing is and how do you employ it in your portfolio allocation and decision. So, largely in today's session, we will talk about long term investing. So, I personally believe it is the only approach to investing, but there can be many approaches to investing. So we have chosen the subject long-term approach for investment. So even the first page gives you a lot of broader goals about what long-term is. So short-term is on this upper hand of the pick where you are talking about news flows and everything and what the volumes are doing, and it's mostly like a voting machine wherein in a day maybe a government is decided or your fate is decided. But on the longer term of it, we decide on the basis of in the way the weighing machine operates, where we weigh the company fundamentals, we weigh the market values, we consider valuations and a lot of other variables based on which we decide that whether we are going to invest in a company or not. The other aspect is basically long-term investing objectives, which is very important that you have to understand what objectives are there with you, because based on which you are deciding your long-term investing objectives, whether it's creation of wealth, minimization of risk, sustainable growth, association with quality companies, reduction of taxes and fees. One advantage of long-term investing is that since the churn is lesser, you end up paying much lower taxes, much lower fees, much lower transaction costs, so thereby they add to your returns. And the third thing is that what are the long-term investing options? So it could be real estate, gold, mutual funds, stocks, PPF, employee PF, bonds, bank fixed deposits, company fixed deposits, ULIPs, post office saving schemes, IPOs. You could choose anything out of this based on what you do. But what we would largely be talking about is basically direct equity investments as a good long-term investment, or direct equity or mutual fund investments. Uh, on the long-term investing strategies, the basic things that you need to understand is understand the insides of the business. For that, you need to understand the industry per se. You need to review the company's balance sheet, envision the company's profit and growth, analyze company's adaptability to technology, focus on company's next 3, 4, 5 years, competitors analysis, evaluate a company's competitive moat. So moat, most of us are very clear. And then the quote at the bottom says that the four most dangerous words in investing are "it's different this time." I also fear that the most. When people say that it is different this time, and most probably the markets would behave in a manner different to how they have behaved in the past. So the next thing that we want to talk about is what is long term. We see a lot of confusion with people on the generic side, where people are not very clear what long term is. How do you define long term? So some people define long term as 3 months also, but this is a brief survey from CNBC. This was some time back around 2014, and most of the investors largely seem to believe that 5 to 10 or at least 10 years or 10 years or beyond is your long term. So be very clear that when you are trading or doing some short term gimmick for a 3 month, 6 month, 1 year kind of thing, because after 1 year it becomes LTCG, long term capital gain, it does not mean you have invested for the long term, because for a business to realize its potential, you need to give it more time to stay on the horizon, and based on which you can generate the alpha returns out of that. So the second thing is that this is the markets, how they have been working in the last few months is very jittery. People are very jittery. Anyone new to the markets or anyone even old to the markets would be jittery, because every time the market is correcting by somewhere around 10-15% every 1 month or so. So that's a bit scary for everyone every month to see a 10% drawdown on the markets. We have seen earlier similar drawdown 6, 8, 10%, which is very normal for the market. And during COVID, we saw a 38% drawdown, a very steep cut, which mostly unnerved many people. But those who stayed the course really made more money out of it than anything else. So I think staying the course is very important. So markets may be volatile in the short term. So if you are not comfortable with an 8 to 10% kind of drawdown, or even 30% drawdown occasionally, this may not be the right asset class for you. But if you are into it for the long term, there is no problem. So what is the antidote to ward off this? So courage, as is rightly said here, that courage taught me no matter how bad a situation, if the company and your fundamentals are intact, you will get out of it, and ultimately they will pay off. Now, this is a chart about what the Nifty has done from 2012 to 2022. So we have corrected roughly 10-15% from the top. But in spite of these sharp drawdowns of 10-11%, which have happened quite often during this period, past 2014, we saw even sharper cuts happening in the markets. But in spite of that, if you see, the long-term return has been somewhere around 254%. At the peak, it was around 300% plus from the lows of 2012. So it's not, if you are into it for the long term and you can stave off the volatility, sit off the volatility, do nothing during these volatile times, and stay with your identified long term strong stocks, then there is a considerably high probability that you would be making much decent gains. Now, yes, all the gyan is easy with historical data, but how does one do it in real time? That's the question most would be asking. I mean, these are data points that would be shown to you quite often across various presentations, that you could have bought Nestle during the IPO, Infosys during the IPO, but how do you buy an Infosys during the IPO? I think that's the question that most people don't have an answer to. So the individual investor should act consistently as an investor and not as a speculator, as Ben Graham has specifically said. So once you decide on a strategy, you need to consistently stay on it, that you do not speculate. You do not turn a speculator after things start moving in your favor or even against your favor. You need to stay the course of a longer term to gain this kind of cumulative returns. Now, this is Kal Aujar Kal, seems like a film title. So what has happened in the last 2 decades, what has happened in the last decades, which I consider the recent trend, considering 5 to 10 years is a decent investment or a minimal kind of decent investment horizon. And the third slide, which is this one, what may happen in the next decade, it basically tells you about what could transpire over the next 10 years or so. So what we have done here is, in the first thing, we have assumed that from 2010, 2000 to 2012, you would have made returns of around, so this is the past two decades and 2 years basically. So we have assumed that since bond returns were higher, you would make around 11% returns, right? So you make 11% returns on bond, and the equity markets return just 12% during this 10-12 years. This is a simple buy and hold strategy where you did nothing else, right? But your rates were particularly higher, around 11%, and we have seen three big corrections actually within this time frame, 2000 to 2022. We are talking about three big corrections. One in 2008, which was very steep, then something of sort of that correction in 2014 to 15-16, and the last one being the recent one post COVID, actually, which started in small caps and mid caps around 2018. So considering that, what you made is, the equity markets gave you a 12% return, the bond markets gave you an 11% return. So it does not look very attractive that equity is something that is going to stupendously outperform. But now let's go down to the next slide, next time frame basically. So the time frame is the current time frame. Last 10 years, what has happened? Suddenly your equity returns have gone up, and your bond returns, we have assumed at around 9%, considering no reinvestment risk and all that. So even considering that, you made just 236% return on a bond on an FD, while your equity markets returned around 246%. These are flat annualized returns on the index basically. So even putting your money into an index with no timing, nothing done, and just beating your benchmark by around 4% per annum, your ultimate end result is very different. 1 lakh turns into 2,36,000, while 1 lakh turns into 3,46,000 over a 10-year period. That's a substantial difference when the corpus size is bigger. We will talk in detail more about the effect of compounding and everything later on. Now that is why equity is a good asset class to be in, because long term many things are factored into it. So the volatility is generally warded off and the returns are more comparable. And lower the interest rate, better your returns will seem out of equities. That is why we speak that whenever in a low return kind of scenario, or broadly the returns are lower, your equity performance will be much better. Coming down to the third part, which is the most illustrative part actually, that what might happen over the next 10 years. We are sitting in 2022. What might transpire over the next 3 years? So next 3 years, you cannot expect your yields out of interest instruments like bonds and FDs to be more than 8%. So what has happened in the first slide, we were considering a 20-year period where making 11% returns. Right now, we are talking about a 10-year period where we would be making 8% returns, while equities would make a 16% return. This is assuming that we will somewhere over the next 10 years get a peak multiple on the index, and earnings would grow at around 13 to 14% per annum over the next 10 years. A bit optimistic, but I think that's doable. Then if you look at this, the bond FD rates have generated a return of 116, would generate a return of around 116%. So just 1 lakh tons roughly doubles, while your equity investments would more or less quadruple over the next 10 years. So there is substantial scope of outperformance, even considering 10-12% kind of earnings growth for the stocks, considering current valuations. So that is the importance of buying at a lower valuation, because in these cases, the earlier two cases, we have just randomly picked up a date 1/1/2020, 1/1/2012, or 1/1/2000 basically. We have backtracked from the current date, and we have just put up a date irrespective of what valuations it was traded on. So later on in the slides, we will talk more about why valuations are important and how come valuations can play a very important role in defining the alpha you generate when you invest in the equity markets for the long term. So these are the tenets of long-term investing. So basically it lies on 4 things: quality, value, diversity, and time. So quality is very important because you want to buy strong, fundamentally sound stories, which will live through this period of 8, 10, 15 years that you are wanting to buy into. Why it is important? Because compounding can only happen when you stay invested in a good company, and for you to stay invested in a good company, the company has to live through that time frame. So quality of the company is very important. What is the quality of the management? What is the quality of the earnings of the company? What is the ability of the company to pass on the higher cost to the end consumers? And how good is the product or the industry per se to survive over the next 10-15 years? In current times, it will be a difficult choice because the way transformations are happening in many industries, it is very difficult to pan out a 10-15 year kind of outlook. But in most industries generally, which are connected to our daily consumption and everything, you can form a 10-15 year view that more or less this will be in place over the next 10-15 years. It is difficult on the disruptive side of it, but generally commoditized businesses and generally consumption driven businesses or service industries, you can more or less ascertain that this will be in place. The demand for the product or the service will be in place for the next 10-15 years. The second important aspect is value. So what is the price you are paying for getting a particular product? So that is very important. If you are buying a very good company at an obnoxious valuation, the probability is that your waiting time will substantially increase. That has happened in the past. You take n number of companies where people bought at a 30, 40, 50 times forward earnings, and the only thing that they ended up was they stayed invested into them to see through the corrections, where nothing changed in the companies, but earnings also did not collapse, but your perception changed and your valuation multiples usually halved or withdrew by say 20-25%, and that resulted in a 25 to 30-35% crash in the stocks, and you had to hold on to them for a much longer time. In spite of them being good quality, you bought at a valuation that was substantially higher to what you could have bought, and that is why you ended up waiting a longer time. And the higher risk comes from it, where people cannot wait that drawdown and people exit those stocks thinking, whenever I buy the stocks go down, I'm a very unlucky guy, as if the stock market knows. But the stock market doesn't really know that you have bought something, right? हमको stock market को नहीं पता आपने खरीदा है. So it is basically you are buying at a hype where you listen to about the stock everywhere you go, everywhere on TV, or a friend comes in and tells him, look at this has gone up by 50, 60, 100%. This has been a 5-bagger, and then you jump onto it, and that's not the way to do it. So always consider valuation, understand valuations, and understand at what valuations you are buying a story and whether you can logically defend that valuations. The third thing is diversity. You might be very good, you might have picked up a stock which is perfect in terms of quality, you might have picked a stock at very good valuations, but whenever you are buying a stock for the long term, you are getting an interest to participate in an industry. An industry has two kinds of risks. Some are internal to it, some are external to it. Today, you bought steel at very fabulous valuations, though it is a commoditized business, not recommended for many. But if you had bought steel and the government suddenly came in and put in an export duty, and maybe it does not impact the financials so much, but the market sentiment is destroyed and they crash by 20-30%. So you don't know. If you had all your portfolio into steel, it makes you more jittery. But if you had 10, 15, 20% of your portfolio and a 10% fall, that means more or less you lost 2% on the total portfolio. So that doesn't jitter you so much, and you are more liable to stay the course than actually panic and get out of something. So diversifying is very important at the industry level, at the stock level, even at the strategizing level. Like later in the slides, we will talk about what types of investing are that. There is growth investing, there is value investing, there is blend investing. So out of these, whatever process you take, you need to diversify your risks across various themes, various industries. Within industries, you could diversify it across stocks. Like within banks, you could choose some allocation to PSU banks and some allocation to private banks. And the fourth thing is time. Time is very important, because the more time you give, the more compounding effect you receive on the stock. Because the first levels of compounding or your initial investment don't really sound that material, but as time goes on and compounding takes its shape, we will see it in later slides that how compounding in the later stage after 10-15 years, the multiplier effect is much higher vis-a-vis what we see in the normal course of time. So what are the problems with the you have to avoid the Bermuda Triangle. So the Bermuda Triangle is uncertainty. So uncertainty is what, suppose you are buying into a company where you're not certain what numbers will come in, what will happen to the industry. It is a highly disruptive industry. You don't know what will happen. Today you buy a stock, you don't know what technology will come in place and will disrupt it and totally maybe take it to the next level higher, or maybe totally destroy it. So there, such uncertainty is not to be taken on your portfolio for very long-term investment. For very long-term investment, you want to stay with a company which you can more or less gauge and understand. So a lot of uncertainty, or to even mediocre uncertainty, is not good for buying for the long-term portfolios. So that is why you see the premium in an FMCG stock, maybe because there is not that uncertainty part of it. You can assign a 10-year portfolio to an FMCG stock that we will continue to consume those products over the perceivable future of 10-15 years. Complexity. So suppose there is a business which you do not understand, or the business itself is so complex, it has 5 countries in place, and it has 5 country operations, it has 6 different products, 8 to 10 raw materials, some imported, some indigenous, and every time you look at the numbers and you try to understand what the numbers will be, and the company comes up with a special one-time thing or something like that, and you can't really make any head and tail out of it. So complexity is something that you avoid for your long-term investments. You buy into simple companies. Depending on your ability, whether you're able to decipher numbers out of those complexities or not is a different thing. And the last thing is bias. So everyone has some biases. I have a bias. If you tell me a textile stock, I'm always biased towards not buying one. So you might have a bias. You might feel that because you drive a Maruti, you should own a Maruti. That should not be there. What is good for the country, what is good for you as a consumable, is not necessarily going to be a good investment. So that is one aspect. You can look at it, but always consider the valuations and the underlying to form an opinion as to whether it is a good investment or not. It might be a good product. Fisher was a very good airlines to have, was a very good airline to travel in, but was it a good investment? No, it wasn't. So history has always made it very clear. So similarly, long-term and the second point is long-term investing is not buy and forget. So buy and hold is one thing, and buying and forgetting is one thing. So you must have heard stories from many people that they bought Infosys in the physical form, they still have it in physical form, and it's made stupendous returns for them. But that's not a very advisable strategy to have. You don't understand anything, that's fine. But ideally, when you are planning something for a 10-15 year horizon, what is recommended is that you understand. That is by luck that you bought it and held on to it and you forgot it and it made money. But for every Infosys, there are n number of non-Infosys kind of DSQ software or something like that, where you would have lost or huge amount of money, actually total money. So there are stocks that get delisted over a 10-15 year time. So it does not mean that you don't need to just look at it, you buy and forget. So you have to do a periodic review, which is very critical. Periodic review consists of looking at the quarterly numbers, looking at whatever announcements the company is making. You might not do it on a daily basis, but you should look at it occasionally as to what you thought and how it is transpiring into a story over the period of times. So regular and rigorous evaluation of all your investment at regular intervals. So regular and rigorous. So it is, many people think that investing is very easy. You will just sit back, relax. Yes, it is easier maybe than a trader's life who has to just live minute by minute and watch every volatility in the markets. But still, yeah, over a regular interval, you have to rigorously track your investments. You have to regularly track what is happening with your companies, how the management, what the management is saying, what is the outlook, what is the industry doing, and what transformation or change is happening. That is very important that you keep a tab of it. You might buy it for the long term, but you have to review it on a regular basis. And at the same time, not doing anything is a task that is easier said than done. So when I say don't do anything over a longer period of time, holding on to a stock for a 5-10 year period of time, when every second day someone on the TV gives you an opportunity, or even on your personal level, or your broker or someone comes to you and tells you this is an uninteresting story because it has not moved. ITC is a classic example, right? Everyone was making fun of it for the last 6, 7, 8, 12 months, right? And now suddenly everyone wants to buy ITC. Now we hear that we were busy making memes on ITC while FIIs were lapping it up. So we kept telling stories ki ESG is a problem. So, it's a tobacco company and it is not doing very well. So ESG is a problem. So it should trade at abysmal valuation. So it is a classic example that if you buy a quality company at base valuations, the probability of you losing money is reduced, which is called margin of safety. And at the same time, once the performance comes into it, the PE re-rating, or the clawback of PE to the mean reversal, will substantially increase your profit. So look at ITC today; it's in a different league altogether. The markets crashed and it did not. So, and today most probably some data has come out which is reflecting that FIIs were buying throughout this period. So not doing anything in this era actually is even more difficult, because you have so much information overload thrown at you through social media sites, and everyone is an analyst, everyone understands, and everyone knows that this is not to buy. But I think mostly people understand price, they don't understand value. So once you get value into your system, you will be able to better differentiate between what is trading and what is investment. And keep emotions and ego out of the process. So you don't get too emotional or egoistic about it. You may have done all the research, you have been very judicious about how you do your research and everything, but still you can go wrong. Maybe a 5-10 year idea goes bust after 3 years, goes bust after 4 years. Something or the other happens. A management does something which is stupid. They diversify into something which is not worth it. Has happened with companies like Mindtree in the past. Like, they got into smartphones and all that, which was hardware driven, and the value crashed. It is an excellent company. Now, Mindtree is an excellent company to have, but prior to that also it was an excellent company to have. But a single decision really caused a big market crash in the prices, and most probably they ended up writing off a lot of money out of it. So keep your emotions and ego out of it. You don't fight with the markets. If you have identified something, and based on those understanding, if you feel that it is not working out as you thought it is, it's better to get out of it. And at the same time, don't be too emotional. Like I told you, textiles, I don't like textiles because I have some past experience which is no bad. So that is all to be kept out of it. Or because you bought something and it went up, you feel that you got to be into that company or that industry. Those are emotional biases. You don't need to have them. You just need to be judicious about the process that you follow, and just follow the process, and according to that, whatever comes up, you work on that. So know what you own and know why you own it. So what you own and why you own, if those subjects are clear to you, there should be no problem with you. You should be very safely through the ups and downs of it. Now, what are the long-term investments? So as I was speaking to you earlier, there is a growth style, there is a blend style, there is a value style. So actually, growth is basically where you invest into companies that can self-sustain their growth and have the ability to invest at high rates of return. Blend is basically a mix of value and growth, where you allocate things across both these aspects, across value and growth, and try to give them a balanced approach basically. And value is basically, in terms of valuation, you decide that companies that experience an improving trajectory brought at an attractive valuation, you keep buying in with a margin of safety. In this, we will largely be talking about the value style largely. What is value investing? So value investing is a strategy that is based on a principle that says the stock price of a company does not necessarily reflect its true value. So ITC, as I told you just now, was a classic example. So how do you decide? I mean, how could that be? You might ask. It's simple, right? It's because the stock market fluctuates based on emotions, fears, expectations of the investors operating within it. Like right now, HDFC, there is a lot of selling, right, throughout the group. So that also is something that has to be understood, that when there is a lot of selling, because ultimately in the short term, what will happen? Your selling and buying activity decides what kind of pricing environment you enter into. But in the long term, what will happen? The numbers will replace. So once things fall in place and the company start delivering on those numbers, the valuation multiples usually claw back. So it can remain exaggerated on either side, on the bullish side as well as on the bearish side. That is, multiples can be exaggerated on the upside as well as on the downside, and can stay there for an umpteen number of years or for an elongated period of time. But you have to stick to your conviction, which is based on your understanding of the business and the long-term multiples that the company is getting and the long-term growth trajectory that the company is going to be in, and whether the logic that is being thrown at you through various information overloads, is it worth it? Do you want to stay with it? Now look at this chart. As I was explaining to you earlier, that what happens to compounding, right? So you start with the corpus of around 80,000, right? This is a growth rate of 15% per annum, right? Above we explained it was 16%. So even 15% is okay, decent kind of growth rate for equity investments. So 80,000 turns into 1,60,000, then 3,20,000 by 10 years, 6,40,000, 12,80,000. Now suddenly over this period, which is after 20 years of being patient, the corpus size is growing enormously, right? So the last 20, 10, 15 years. So this is why starting early is very important for your investments, and giving it time is also very important, right? So look at this last 20 to 35 years, which is the last 15 years. This is where your corpus really escalates into something of a different magnitude, which can change your lifestyle, which can change your life, and which can support you big time even in the post-retirement age. Because most probably, if you started somewhere around 2025, your investment journey, by the time you have invested for around 35 years, you are what? You are already 50, 60, right? So this is when you need the money. You might occasionally need the money according to the flow of information during these times, for education, for marriage, for children's education, whatever. But if you have this surplus money passed into this through SIPs, through direct equity investments, good long-term stories, this is what you end up making. So that is why time is very important. So buy not on optimism but on arithmetic. The more you base your total understanding or the total investment approach on arithmetic, that is understanding and why. There are many people who talk, we look at corporate governance. Now how do you measure corporate governance? If you have no methodology to measure corporate governance, how will you say that a company is good at corporate governance? You can't do a 2 plus 2 to understand corporate governance, so it will need something else. So similarly, a company has the ability to pass on higher costs to the consumers. How will you get it into numbers? That is very important. So arithmetic is very important. So just simple optimism will always lead you into the bull trap, and you will fall into it. But the best thing is that you keep your arithmetic strong, that you consider your numbers as to based on which numbers you will buy when and at what valuations. It is important that you study the company. Studying the company is very important, because we generally the more we understand about a company and industry, the better our understanding will be, the less jittery we will be in case the price movement is not in our favor. We are most jittery when the price movement does not happen in our favor. Today I buy a stock and it goes down by 30% or 40%, and there is a plethora of analysts and people coming out and telling you why the stock is a waste, actually, because most of the analysis is based on prices. Once the prices perform in a particular way, the analysis comes in to support it. So unless and until you have that in-depth understanding and conviction, then you cannot stay the course. Stay with the company you have invested in for a longer time, irrespective of price movement. Either ways, even if it has gone up too much, you need to review whether it's at a relevant valuation level or it has become too expensive and you get out. Or even if it has cracked and if you are were not sure, you should review it, that it has gone down by 30-40%. You could make any percentage threshold according to which you review it. But you review it, then don't just panic and exit based on a certain price movement percentage. Paying a fair valuation for a good business is better than buying a good business at a very high valuation. So this is the trap that most people fall into, where you are told stories that anything can be bought at any valuation. Yes, good companies, today you buy a Lever, today you buy a Dabur, today you buy an XYZ company which is going to stay the course for the next 15-20 years. It will not vanish, it will not wipe out. But the percentage return that you make if you buy at a very high valuation, peak valuation, sentimentally, when everyone seems to be buying it and the valuations are at their highest over the last 10-15 years, then there is a probability that you might not make money for a substantial period of time. So suppose you don't make money for the next 2-3 years in an FMCG stock. So that results in lower returns for your total portfolio over the next 10 years also, because 30% of the period you just sat on it and waited for it to come back to a price you bought into. So paying a fair valuation for a good business is better than buying a good business at very high valuations. So very high valuations is, suppose historically a stock traded at 30, 20, 25 times. Today the stock is available at 50 times. Though it has become very difficult during these COVID times to understand that what the valuations are, because the base effect and everything has been thrown haywire. So you need to be more diligent in trying to understand that whether it's a numerator or denominator effect. But generally, if you're buying something at very obnoxious valuations, you should relook at it whether you want to buy it or not, and you should delve deeper into understanding. And if you cannot do all this, get a good advisor on board who can do the above, which is not an easy job. So the same thing is written below. It's far better to buy a wonderful company at a fair price than a fair company at a wonderful price, and we all know who says this. There are certain myths to run down what we do. The first thing is that buying and holding for the long term does guarantee profits. Like, people think that buying and holding for the long term we will only make profit. That is not guaranteed. There are economies where people invested for 10, 15, 20 years and they did not make money. There are stocks which have not made money for the last 15, 20 years. There are n number of stocks where you would not have made anything close to what you bought at if you bought something 10 years back. That is where diversification comes into place. So buying cheap guarantees returns and or wealth creation. So many times we see people come and talk that this company is available at a price to earning multiple of 3, 4. So that is why it is a very good investment and you buy into it. So there are examples in history where something was cheap in valuation for the last 20 years and it never performed, and some stock even got delisted after that. So something is cheap because of a reason. So try to understand the reason why that stock is trading at cheaper valuations. Just because it is trading at cheaper valuations is not the solo thing to identify and jump onto a stock. Future returns, growth, management pedigree, these are things you need to look at. Many people say there is no such thing as too much diversification. Yes, if you think like a Peter Lynch and you want to buy 1% into everything and have 100 stocks and you have the ability to manage those 100 stocks, there is no such thing as too much diversification. But in most cases, what I think is that anything beyond 20-25 stocks is too much diversification, and it does not really lead to much wealth creation. And diversification beyond a point actually leads to wealth destruction. So past performance guarantees future returns. So if something has done very well over the last 10 years, it does not mean that it will do very well over the 10 years, and vice versa also, that if something has not done good over the last 5-10 years, it will not do good over the next 5-10 years is not true. Accumulating stocks on every dip guarantees profits. Now this is where valuation comes in. Suppose you buy something, you avoided buying something at a 100, 150 kind of multiple. Today it comes down by 30%. So it's still trading at a 100 PE multiple, right? So you're not buying it cheap. So just because it has gone down and you jumped in to buy, it does not give you money. Well-known companies make good investments. Well, contrary to that, well-known companies usually trade at much higher valuations, so you don't make much money out of this. The second line actually gives you much better returns. So well-known companies is like the quality for which you have to find value. So quality is available to you at a decent valuation only occasionally when markets crash across the board, like it happened during COVID. Happened during 2008 collapse. Partially it happened over the period of 2014 to 16. So that only occasionally happens. That does not happen every now and then. So the waiting time for you to enter into that will be much longer. It's better to have smaller portions allocated at regular intervals and keep buying on regular intervals. That is better. You only risk what you are able to lose. So if you are putting money into a business, so don't try to time it too much, and you have to understand that even in spite of the best of intentions and best of research, businesses can fail. Reinvest dividends. There are many people who don't reinvest their dividend incomes, and they spend into the reinvesting will substantially affect your compounding effect. And invest in the things you understand. So don't buy a business you don't understand just because it is growing. So if you don't understand, you will never be able to understand the nuances based on which it can go down. So the external environment that is changing, how it is going to impact a particular investment, you will have no idea about it. So you need to understand basically the business and the company to make a decent decision. Diversify among different sectors and markets. We have already spoken about it. Create a plan and avoid panic selling during sell-offs. There will be sell-offs. There will be a Russia-Ukraine war tomorrow. There may be a China-Thailand war, but just don't run into it that, oh, it's a war, it's going to end everything. If everything's going to end anyways, that's not a big problem. So at the final and foremost thing, which is no wise pilot, no matter how great his talent and experience, fails to use his checklist. So try preparing a checklist of what you want to look at in a company, because irrespective of how intelligent we think of ourselves, you need to have a checklist of what you need to look at into companies and understand that what are the things you want to identify or locate in every company to understand, right? Like whether they're able to pass on higher costs, whether they're able to sustain margins, whether they're able to whether they are managing their debt properly, whether return ratios are proper. So you make a checklist of those. You can't remember everything. Every time you go to invest into a company, try making a checklist and try refining this checklist regularly so that you can make proper informed decisions. So basically, we have not spoken about temperament. Temperament is something that is very important, and this is a small question that I want to ask you. I believe, yeah, we have run through most of the presentation. So if I give you 10 lakh rupees on May 1st, would you take that, or you would take 1 paisa doubled every day during May? Compound value, right? Compound value of 1 paisa doubled every day during May. So which is the one you would take? You can type in your answers in the text box or something, and within that I'll explain these 5 6 more tenets. So temperament is very important. Compound interest, compounding, the impact of compounding is very important. Starting early is very important. And the cliche time in the market, like Rohit Sharma keeps telling this, Shreyas Iyer across TV ads in mutual funds, sahi hai. Give time to the market, not timing the market. And the last thing and the most important thing, one of the most important thing, is to diversify across stocks, sectors, growth and value themes, and any number of themes that you look at. So now coming back to this, the secret to investing is to figure out the value of something and then pay a lot less. So I think the most important thing is whether you can figure out the value of something. We all find it difficult to figure out the value of things. So once you follow these processes and try to understand the company and industry, you will be able to find the value of something, and then you will be able to understand whether it is at a discount or a premium, and then you will be able to pay a lot less for that. Now, I don't know how many of you chose A or B. This gentleman here is known to all of us, I believe, right? So this is Mr. Warren Buffett. So look at this. Till 59, he was just 3.8 billion, right? So this chart looks very similar to the chart we showed above, that how compounding in the last phase of it works. Obviously, stock markets have also helped him over the last 16, 17 years. But look at the compounding effect. This 3.8 billion has galloped into 58.5 billion from 59 to 83, which is roughly what? 23 years, 24 years, right? So, yeah. And then what happened to the compounding that we did, right? So if you chose to take that 10 lakh rupees from me on 1st May and you ignored the impact of compounding, you ended up losing roughly 2 crore rupees, right? So that is the impact of compounding. I believe I've just completed the presentation. So any of you have some questions regarding investments or something out of the slides, you can ask me. I'll be more than happy to help you.